RSM's financial reporting update for 2023. So my name is Ralph Martin. I'm the National Technical Director at RSM. And what I'll be talking about for the next hour or so is everything you need to worry about when you're preparing your 30th of June financial statements. Now, I'm sure everyone's familiar with Zoom webinars, but just a reminder that if you have any questions, feel free to write them in at any time. Just use the Q&A box on the bottom of your screen. So, what are we going to talk about? Well, we'll start by talking about changes to accounting standards, but actually this year, for once, I don't have that much to talk about in terms of changes to accounting standards. So that's okay. There's plenty of other things to talk about. I'll talk about IFRIC agenda decisions and what they are and why they're important. We'll discuss what ASIC are doing, where they're focusing, and why you maybe should be worried about it. And then I'll have a look at what's happening in the not-for-profit sector, before finishing with talking about this new concept of greenwashing and how that links to the more general requirements about sustainability and ESG. So that's what we'll start with. But before I get into changes to accounting standards, what I'd start with what I might call a few what's new items. So if anyone works for an ASX listed company, this is probably the most important thing for you that I'm going to say today, because they've changed the deadlines. Well, they haven't actually technically changed the deadlines, but in reality they have. Why have deadlines changed? Well, it's because previously you were allowed to lodge not on the deadline itself, but on the next market's day, as long as you lodged before trading started, which is usually 10 a.m. Sydney time. So yeah, if there was a deadline, you had effectively an extra day. Now that's no longer going to be the case. Now, and this applies to both the interim financial statements and the end of year financial statements. Now, if you have a deadline, then you must lodge when the market announcement office closes on the deadline day. And the easiest way to remember that is it closes 5:30 p.m. Perth time. So it changes with daylight saving time in the east, but always 5:30 p.m. in Perth is when the market closes. And if you don't lodge by that date, you will be suspended, regardless of whether you lodge by when the market opens. So because of the way weekends fall, that's a particularly significant issue this year. So for both of the August deadline, but particularly for the September deadline, previously you would have been able to lodge by Monday the 2nd of October, 10 a.m. in Sydney time on Monday the 2nd of October. Now you have to lodge by Friday the 29th of September, and in Sydney time it'll be 7:30 because no daylight saving at that time, 5:30 in Perth, Friday on the 29th of September. So I think this is great because I get my weekend back for that weekend, but for everyone else, they've taken a few days off you, and we always have quite a few listed companies that do lodge at the last minute. So beware of that, because you may end up getting suspended if you aren't aware of it. Next thing that's new is the end of grandfathering. Now, this is a relatively niche thing, although it's a very big deal for those companies that are affected. The background to this is that in 1994, when the Keating government introduced the present definition of a large proprietary company and said that they had to lodge financial statements, they made certain companies exempt. And look, I won't go back to 1994 and discuss the exact definition, just say there were about 2,000 companies initially, and gradually that dwindled to about 1,100 companies that basically had special privileges. They didn't have to lodge their accounts on public record, unlike anyone else, no matter how big they were. And some of these companies were very big and very influential, which is why they were successful for so many years for lobbying for this supposedly temporary exemption to remain. Well, what happened, and the politics of this is quite interesting, is that in a bit of legislation to effect cyclone relief in Queensland, the senators actually slipped in a little clause to abolish grandfathering. So that happened last year, and therefore 30th of June 23 is the first year that it's gone, and all of the entities in question will have to report like any other live proprietary company. If you want to know any more, I've got the link on the slide there. That's the article I've written to explain the impact of this change. Last change for anyone who holds a financial service license. Sit up and pay attention now, because this will affect you potentially. So if you work in the for-profit sector, you're probably familiar that special purpose financial statements are no longer a thing. That happened a couple of years ago. You couldn't do special purpose financial statements anymore. Everyone had to lodge general purpose financial statements. But there was one small exception. If you were a small proprietary company, but you held an AFSL, then you didn't have to lodge financial statements under Chapter 2M of the Corps Act, but you had to lodge a Form FS70 with ASIC, and Form FS70 required you to have financial statements, income statements, balance sheets, and so on. But until last year, you were allowed to lodge special purpose financial statements. That's gone now. All AFSL holders must prepare general purpose financial statements. And the other thing ASIC have changed is who has to do Tier 1 full IFRS and who has to do Tier 2 specified disclosure standards, so reduced disclosures. Now, the rules there are quite complicated, and they're a bit different to other companies. So there's a big long list of everyone who has to do Tier 1. I'm not going to try and put it on the slide. All I'm going to say is if you have hold an AFSL, go and read Form FS70, the new version, carefully, and work out whether you need to do Tier 1 or Tier 2. Right, let's talk about what's new in accounting standards for this year. And the good news is not that much. Now, remember, the effective date here is the effective date for periods beginning on or after that date. That's how accounting standards are always written. So if a standard's effective periods beginning on or after 1 January 2022, then it'll apply for the first time for 30th of June 2023 year ends. So only a couple of standards to talk about there. There's a few more for 30th of June 2024, but when we get there, I'll talk about why you might need to think about them this year rather than leave them until next year. So first thing that's new for June 23 is onerous contracts. Now, the idea of having provisions for onerous contracts is not new. That's been in place for many years, but what it said always is that if you have a contract and the costs of fulfilling that contract exceed the income that you're going to get from that contract, then you have to bring the loss forward. You have to immediately make a provision for that onerous contract. That hasn't changed, but the question that ASB 137, the relevant accounting standard, was always silent on was, which costs? Which costs do I have to look at when I do this calculation? Is it all costs of the contract? Is it direct costs only, or is it incremental costs only? Previously, ASB 137 was silent, and therefore there was diversity in practice, but most preparers probably took incremental costs only because that's how you got the smallest provision. Now what ASB 137 says is there is explicit guidance. They've added a few paragraphs in there. And it says not only do you have to include the incremental costs of fulfilling the contract, but you also have to include an allocation of other costs that relate directly to fulfilling the contract, even if they're not incremental. So fixed costs, even if they're fixed and you'd incur them anyway, if they relate to fulfilling the contract, you have to include them in the calculation. And that would include things like PPE, include things like storage and warehousing if you need that. It would include staff costs. It would include equipment hire if you're renting equipment, and then the other direct overheads. So what this means, I think, is that potentially there are more onerous contracts out there than we initially thought. And that's particularly the case in the current environment, where a lot of companies, particularly in areas like construction, engineering, mining services, may have quoted on work a year or two ago. The cost of materials has increased significantly. The cost of labor has increased significantly, but they're not able to increase the price of the contract because that was locked in. So what looked like a good contract with a nice margin in may now have quite a low margin or even be loss-making. So that is something that should be a focus area, particularly for anyone in those industries, but really for anyone else who has potentially onerous contracts as well. Okay, the other thing that's new this year is proceeds prior to intended use. So the circumstances we're talking about here is when you build a big asset that takes a long time to build, and after you've built it, there is a ramp up, testing, commissioning, training phase where you're producing some product, but you haven't yet reached full commercial levels of production. So this applies, the most obvious example in Australia is mines, when you build a new mine and you have a commissioning phase, but it also applies to things like heavy industry, chemicals plants and so on, where during the testing or training or commissioning phase, you'll produce a little bit of product. And the issue was, if you then sell that product, how do you treat the income from it? Do you treat it as revenue, or do you deduct it from the cost of constructing the asset? Previously, accounting standards were silent, so again, there was diversity in practice. So what is changing is that sale proceeds may no longer be deducted from the cost of the asset. Instead, they should be treated as revenue, or potentially as other income if they're not part of your ordinary activities, but usually it will be as revenue. Now that's relatively simple, but the more complex bit is the bit in the bottom half of the slide. So if I'm producing product on a non-commercial basis and I haven't yet sold it at year end, but it's in my inventory and I'm aiming to sell it later, then I have to treat it like any other inventory, recognize it at the lower of cost and net realizable value. The issue, of course, will be because you're in a pre-commercial phase, you're in a testing or ramp-up phase, the cost per unit of your inventory is probably going to be much higher than it would be once you get to full commercial production. But you still need to work it out and recognize your inventory at cost, and then you'll need to assess what's the net realizable value of that inventory and recognize the inventory at the lower of cost and net realizable value. And if you're in a pre-commercial phase, it's probably quite likely that the net realizable value may be lower than the cost. Okay, that's everything that's new for 30th of June 23. Not very much actually this year, but what's new next year and why do you need to worry about it? Well, a couple of reasons why you need to think about next year's standards already this year. Firstly, remember what happens whenever we apply a new accounting standard. You have to do it retrospectively, which means you'll have to restate your comparatives. So in other words, when you get to doing your 30th of June 2024 accounts, you'll have to restate this year, 30th of June 2023, under the new standards. But you may be thinking, I can put that off until 30th of June 2024, surely. Well, not quite, because also remember the disclosure requirements of AASB 101, which say that whenever there's a standard that's been issued but not yet adopted, then you have to disclose the fact that that standard's been issued, not yet adopted, and also whether an assessment has been made of the impact of the standard, and if so, what the impact is. And the ASIC have been getting a bit harsher recently with the idea that everyone can just say, I haven't yet made an assessment of the impact and I don't know what it's going to be. Because for some of these standards, I think there's a reasonable expectation that you actually can quantify the impact. So let's talk about what's new. Firstly, insurance contracts. Now, if you are in the insurance industry, this is a really big deal for you. But I am aware that insurance is quite a niche area, and probably 95% of people on this call don't work. I've never worked in insurance and maybe never will. So I'm not going to go through insurance accounting in detail. If you are interested, do get in touch with me. Send me an email, and I'm happy to go through insurance in detail. For the purposes of this presentation, I'll just say we're going from a previous AASB4 model, where you had a fairly wide discretion in terms of how you accounted for insurance contracts and your income and your claims provision and so on. Whereas AASB 17 is a much more rigid, much stricter model, that has quite specific rules about how you calculate each component of insurance. Okay, so that's quite niche, but let's talk about a few changes that are a bit more general. One is to accounting policies and estimates. Now, this is primarily an administrative thing to put a definition of accounting estimates in the standard, but that probably doesn't change much in practice. The bit I would highlight is the bit on the bottom of the slide there, that there is a change to accounting policies. Previously, AASB 1 said you had to disclose significant accounting policies. Now it says you have to disclose material accounting policies. Is that just semantics, or does it actually make a difference? I think it does make a bit of a difference. My interpretation of that would be that, therefore, if I have an item in my financial statements that's material, I must have an accounting policy disclosed. That probably goes a bit further than the requirements of the previous standard, which allowed a greater application of judgment. Quick note on the changes to AASB 112, deferred tax assets and liabilities. I will say on this, I think you probably should have got this answer anyway under the old standard, but it's now been clarified. The entities are required to recognise deferred tax for all temporary differences related to leases, decommissioning, restoration, and similar liabilities. So must do that. That's for next year, but you will have to do it retrospectively for this year. So if you haven't been doing deferred tax calculations in respect to that, you probably need to start thinking about it when you do current year end. Next thing that's changed is around the classification of liabilities. Now, this was presented by the Accounting Standards Board as an administrative change, but actually I don't think it is. I think it does have an effect in substance. Now, the key concept here hasn't changed. The key concept is that when you have a liability, you must classify it as current unless you have an unconditional contractual right to defer settlement for at least 12 months from the balance sheet date. Unconditional contractual right. So key thing there is probabilities, likelihood, estimates of what might happen in the future don't matter. If I've got a bank facility and it's expiring in 6 months, even if the bank have renewed that facility every year for the past 25 years, that doesn't matter. Even if I think they're 98% likely to renew that facility, doesn't matter. If, as at the balance sheet date, they have the right to recall that facility at the end of the 6 months, then I must classify that debt as current. That isn't anything new. The change is so we've got an unconditional contractual right to defer settlement, but there is now a definition of exactly what settlement means. Settlement can mean cash settlement, settlement through delivery of other goods or services, or settlement through issue of your own shares, unless it's part of a conversion option that's classified as equity. So I'll explain that in a bit more detail on the next slide, but it clarifies that it doesn't just mean cash settlement. The other thing that's been clarified, and on this one, I think you should have got to this answer anyway under the old standard, but it's now made absolutely clear, is that if you have covenants as at 30th of June, but the bank doesn't test them until later, until say August, then it doesn't matter when they're tested. If you were in breach of those covenants as at 30th of June, then the debt must be current, must be shown as current. So reminder for anyone who may be in this position that if you have covenants and you believe it's potentially likely that you'll breach them, then you must get a waiver from the bank dated prior to 30th of June. If you breach your covenants on the 28th of June and you get a waiver from the bank on 2nd of July, while that may be a good thing from a commercial point of view, from an accounting point of view, that doesn't help you. As at 30th of June, you didn't have the unconditional contractual right to defer settlement. Therefore, as at 30th of June, you would have to show that debt as current, even if on 2nd of July something happened that would have kicked it back into non-current. So, reminder of that, but let's have a look at what's potentially changed with this changed classification. And I think it's primarily around convertible debt. Now, a reminder of the way convertible debt accounting works. You always split it into two components, the underlying debt and the conversion option. And the conversion option may be classified as either equity or as a financial liability. What that depends on is whether it meets what's called a fixed for fixed test. Convert a fixed amount of cash to a fixed number of shares, and you classify the conversion of equity. You convert it in, if there's either variation in the amount of cash or variation in the amount of shares, then you classify the conversion option as a derivative financial liability. So let's have a look at this example here. We have a convertible debt which converts into a variable number of shares. So the conversion option isn't classified as equity, it's classified as financial liability. So it's got a 5-year term. So I've received cash and I won't have to pay any cash back for 5 years. But the holder can convert it into shares. They can make me issue shares at any time. So previously, IFRS was unclear, but I think most entities would have classified that as non-current on the basis that they didn't have to pay any cash for 5 years. Now, what IFRS would say is that that actually must be classified as current. That must be classified as current because potentially tomorrow, the holder of the debt could make me issue a variable number of shares. Note that if it was a fixed amount of shares for a fixed amount of cash, then that wouldn't, the treatment wouldn't change. You could still classify the debt as non-current. But because it's a variable number of shares, and therefore the conversion option is classified as a financial liability, you must classify it as current. Okay, so that's everything in terms of new accounting standards. I'll look in previous years, I'd have probably spent the whole hour talking about new accounting standards, particularly when we had the new revenue and leases standard, but not so much this year. But that doesn't mean there aren't other things you need to worry about. And the first thing to think about is IFRIC agenda decisions. Now, if you're an accounting technical nerd like me, you probably read these for fun, but if you're not, you may never have heard of them. So what are they and why do you need to worry about them? Well, the IFRIC is the International Financial Reporting Interpretations Committee. It's a body that sits in London and it works to support the work of the International Accounting Standards Board. The way it supports it is that anyone, absolutely anyone, can submit a query to the IFRIC. But your query has to be in a specific form. You have to say, hello, IFRIC. I've been looking at IFRS and I've found an area where I believe IFRS is unclear. And because of that, I think there's diversity in practice that different entities are treating the same transaction in different ways. Please, can you clarify what to do? How should this be treated under IFRS? And the IFRIC can do one of 4 things. They can issue an interpretation. And interpretations, technically, they're not accounting standards, but for practical purposes, they're kind of the same. They have force of law in Australia in exactly the same way accounting standards do. There's no new interpretations this year, but there's plenty of existing ones. If you go on the AASB website, you can read them all. They're on things like uncertain tax positions, lease incentives, settling debt with equity, and there's about 20 more of them. So that's one of the things they can do. They can recommend to the board, the standard setters, that they either change the wording of an existing standard to clarify it, or even in some instances, write an entirely new accounting standard. And there's a project like that going on at the moment on common control transactions. So those are their second and their third options. But the fourth thing they can do is they can take a decision not to add the item to their agenda. And that's interesting because what they'll do when they take an agenda decision like that is they'll write back and say, we've received this query, we've considered it, and we don't think IFRS is unclear. We think it's actually clear in IFRS how you should treat this particular transaction, and here's how it should be treated. So IFRS agenda decisions are what I call semi-authoritative pronouncements. Technically, they don't have force of law in the same way that standards or interpretations do in Australia. But really, if you want to comply with IFRS or Australian accounting standards, then you have to comply with them. I think certainly ASIC would take the view that if you don't comply with them, you're not complying with accounting standards. So you have to be aware of them. Now, the thing that really put IFRIC agenda decisions on the map was a couple of years ago. They issued an IFRIC agenda decision on cloud computing. And that affects everyone, because everyone's got cloud computing, right? Everyone has applications in the cloud. And what the agenda decision said was, if you have cloud applications and you spend lots of money on customizing and configuring them, that is not an intangible asset, because you don't own the underlying code. So you'd either expense it, or in some circumstances may treat it as a prepayment, but you do not treat it as an intangible asset. And that was a big change. That wasn't the outcome I think everyone was expecting from the IFRIC. And therefore, a lot of entities had to restate the way they treated their intangibles and cloud computing software costs. So what's happened this year? Well, there's a few different agenda decisions. Let's have a look at them. The first one is something that looks quite niche, but actually I think is going to have wider application over the next few years as more and more industries fall under green legislation, net zero targets, carbon emission reductions, and so on. So this specific fact pattern is about vehicle manufacturers. And for anyone that doesn't know, if you're a vehicle manufacturer, you have emissions targets, and they're sort of, in a lot of jurisdictions, you have emissions targets across your entire fleet. So across all the vehicles you sell, you have to reach, on average, certain standards for CO2 emissions, emissions of pollutants, fuel economy, and the like. So if I sell lots of gas guzzlers, enormous dual cab utes, then to make up for that, I also have to sell lots of nice, clean, green electric cars or small hybrid hatchbacks, that sort of thing. And if I don't, then I get penalized. And the way I get penalized is quite interesting. I don't get a monetary penalty. But the government will do one of two things. They'll say you either have to go and buy credits from another manufacturer who has been really green and sold more electric cars and non-polluting cars than they need to. So they've got spare credits, they can sell them to you, you can buy them. Or if you can't find credits from anywhere, we'll impose sanctions. And sanctions are non-financial, but there are things like limiting which vehicles you can sell or how many you can sell of certain models of vehicle to improve the overall efficiency of your vehicle sales fleet. So the question was, is that a provision? And the answer is yes. Notwithstanding that there's no monetary obligation, there is an obligation that is potentially disadvantageous to the business, and therefore that should be provided for. And it would be at the lower of the amount of purchase of credits you need to purchase, the amount you have to pay for that, or the potential financial impact of the sanctions the government has imposed. Quick note on SPACs, formerly special purpose acquisition companies. The good news is we don't have a lot of these in Australia. It beats me why anyone would want to invest in these, but apparently they do. They're very common in the US and Canada. So a SPAC is an entity that gets founded and everyone invests money in. And only after this has happened, it sort of goes and looks around for some business to buy. And the question when this fact pattern was, I have a SPAC and people put their money in, but if I don't find a business in a certain amount of time, I have to give them all their money back. If I do find a business, then the shareholders have a vote to approve the acquisition. But anyone who votes no can demand a reimbursement of their shares. So the question was, is that debt or equity? And the answer is that's debt. That's debt. You can't show those shares as equity. So because you have a potential contractual obligation to repay, that's not in your control to avoid. So yeah, the answer was that's debt. Okay, next IFRIC agenda decision was on lessor forgiveness. So the issue here is I'm a landlord, I have a tenant that's struggling, obviously very common during COVID. I decide to forgive them rent for a period until they get back on their feet, and then I'm going to charge them rent again. The question was, how do I treat that forgiveness in my accounts? The answer is, it depends. The answer to all good technical queries, it depends. What it depends on in this instance is, what exactly are you forgiving? Are you forgiving rent for periods that have already passed, or are you forgiving it for periods in the future? If you're forgiving it for periods in the past, then you would use the expected credit loss model in AASB 9, and that is a fancy technical way of saying write it off as a bad debt. If you are forgiving rent that is in future periods that hasn't yet happened, that's potentially a bit more complicated. So let's say I have a tenant and they have 5 years left on their lease. They pay $1 million a year, so $5 million in total left to pay. But I decide to forgive them rent for the first of those 5 years, forgive them $1 million. But I say you still got to pay $1 million a year for the remaining 4 years of your lease. How would I treat that? Well, what you wouldn't do is just write off the $1 million in the next year. What you actually have to do is straight line the impact over the entire remaining lease term. So what I would do with my $400 million in that instance is recognize 800,000 of income each year over the next 5 years. So the timing of income recognition is going to be different to the cash flows. In year one, I'll receive nothing, but I'll still recognize 800,000 of rental income. In year 2 to 5, I'll continue to recognize 800,000 of rental income, but because I'm getting $1 million of cash, there's 200,000 there that I'll use to write down, to gradually write off the 800,000 asset that I recognized in year one. Okay, the next and last IFRIC agenda decision is on substitution rights, and it's an interesting one, this one, because it highlights a bit of AASB 16, the leasing standard that everyone forgets. And that's substitution rights, which say if I'm leasing you an asset, if I'm leasing an asset from someone, in order for it to be leased, there has to be a specific identified asset. If the lessor has the right to substitute it with a different asset anytime they want, that's not a lease, that's a service contract. But those substitution rights have to have commercial substance. It has to be something that the lessor would realistically do. You can't just stick a clause in there as a sort of avoidance mechanism to keep your leases off balance sheet. So the question in this fact pattern was, I've got some buses and leasing the batteries for the buses from a battery company. And if the battery were to be substituted, the leasing company would though have to compensate the bus company for the period that the bus is out of action. So once you look at that, then batteries, it's the same as the battery in your phone. They start off really good and they gradually get less and less effective. So for the first 3 years, there's no possibility that the leasing company would want to replace the battery in any of the buses. There's no economic reason to do so. But after that, they might do so. So the question was, given those substitution rights, and they do have substance, is this a lease? And the answer the IFRIC said is, yes, it's a lease. Because for the first 3 years, the substitution rights don't have commercial substance, and therefore you would treat it as a lease. The remaining 7 years, they do have commercial substance, therefore you treat it as a service contract. So you kind of get to this non-intuitive answer where you have to sign a 10-year lease, but because of the substitution rights, the lease term is only 3 years. Okay, let's talk quickly about the effect of current economic conditions on financial reporting. And the two things really driving things here, and they're kind of linked, is firstly, the war in Ukraine has significantly increased prices of grain and prices of oil and gas. And those two, they're kind of the two most important commodities in the world. They act as a proxy for the price of energy generally and the price of food generally. So the two most fundamental things to the economy and civilization, food and energy. They've significantly increased. As well as that, there's kind of the lingering effects of COVID, both in terms of supply chain disruptions and shortages, and in terms of inflation as a result of the stimulus that was put into the economy during COVID now sort of flowing out through it. Add into that some US bank failures and things looking very uncertain. And for financial reporting, that always makes things harder. And it's particularly hard because IFRS these days has a lot of estimates and judgments in there. So there's lots of estimates, judgments, determination of fair values, and that's harder to do in an economically uncertain environment. So what that means is that disclosure becomes more important, both the narrative disclosures around key risks and how they're managed, but also whenever you have estimates, the disclosure of what the key assumptions are, why they were picked, and also the sensitivity of those key assumptions to changes. So, as I say, I'll give the edited highlights. I could do a whole hour on just the effect of current economic uncertainty. The edited highlights, though, is where you have, remember that you have to do an impairment test wherever you have impairment indicators exist. And that covers all sorts of assets, not just your tangible assets and your intangibles. It also covers joint ventures, right of use assets, and the one everyone forgets, assets not yet in use. That's the hardest one to do because you've got an asset not yet in use. So it isn't generating cash flows yet. You still have to do an impairment test to forecast the future cash flows on the basis of probably very limited information. Quick note on discount rates. IFRS requires you to use lots of different discount rates at different places. I'll highlight a couple of points from this slide. Firstly, when you did an impairment test, remember it's a pre-tax rate. Now, in the real world, we all have to pay tax. So when companies calculate their weighted average cost of capital, they usually calculate a post-tax rate. But you have to then amend that to a pre-tax rate. Let me give you some potentially money-saving advice on employee benefits here. So employee benefits, you have to discount at the rate of high-quality corporate bonds. Now, the issue we have here is that for many years, what's known as the Millman Group, or the G100, have put out a report for everyone to say what the high-quality corporate bond rate is in Australia. They're still doing that. The thing is, they've gone from making it being free to charging you money. I think it costs $200 or $300 now. And unfortunately, we have asked them this. We, RSM, can't buy the report for $300 and then distribute it to all of our clients. That would breach the license term. We're not allowed to do that. So that isn't yet available. So for the tip I want to give you here that will save you $300, you can thank me later, is that if the only employee benefit you have is long service leave, I've yet to come across any company where the difference between the government bond rate and the high quality corporate bond rate is going to make a material difference to your long service leave. Generally, it's a sort of 0.5 to 1% difference in the discount rate. I've yet to come across any company where increasing the discount rate in your long service leave by 1% makes any material difference to your accounts. Last one I wanted to highlight was AASB 137, provisions and contingent liabilities. Reminder that you have to use the risk-free rate on that. You can't use the same rate that you use for your assets. It's a much lower rate. But be aware that because of the change in interest rates, then risk-free rates have gone up significantly this year. That's going to particularly impact the mining industry. Because if you think about a typical rehabilitation provision, it's only due to be paid in maybe 1 to 10, 20, 30 years' time even. So if the risk-free rate goes up by 2%, you then flow that through 20 years, that's quite a big impact to how big your rehabilitation provision needs to be. Reminder of a couple of other things. Insurance receivables. If you have an insurance receivable, you can only recognize it when it's virtually certain. I've included this because we've seen some areas be affected by floods, cyclones, and the like. So I'm afraid the bad news is that if your business is affected by a cyclone, you have to recognize the impairment immediately. You know, your property is very badly damaged, you'll have to impair it immediately. But then the corresponding credit, the insurance receivable to repair it, you can only recognize when it's virtually certain, and that may be quite a bit later. It may be in a future year, because we'd normally only say it's virtually certain when the insurance company has accepted the claim. Okay, covenant breaches I talked about already. Now, ASIC focus areas. What are ASIC doing? Well, ASIC do three things, and they kind of do them all simultaneously in the financial reporting space. They have an enforcement and disciplinary program for anyone who does anything really bad. They have an audit inspection program, so RSM, like all other major firms, inspected every year by ASIC. But they also have a financial reporting surveillance program. And that is a group of people who sat in their office in Sydney, whose job is to do nothing but review financial statements that are lodged with ASIC and check them for compliance with accounting standards and compliance with the Corporations Act. Then review typically 200 to 300 sets each year. And out of that, if they find anything they don't like the look of, they will write to the directors to say, please explain what's in your accounts and how you're happy that it's compliant with accounting standards. Then at that point, there'll be some correspondence back and forth between the directors and ASIC. And one of two things will happen. Either ASIC will be happy and they'll go away, or if there's something they don't like, they'll make the company change. And normally when they do that, they issue what I call a self-congratulatory media release to say, look how great we are. We've got our financial reporting surveillance program, and it's made this company change what they're doing. Now, their biggest area of focus for this year has been actually not financial statements, it's been the operating and financial review. Phrase the ASIC inspector used to me on their liaison call a couple of weeks ago was, it's like shooting a fish in a barrel. I can just go in and download a load of ASX company accounts, see that none of them have prepared an operating and financial review that discloses their material business risks or gives a balanced review of their prospects. And therefore, I'll write them and make them do that. So yeah, that's for anyone in the ASX sector in particular, that's, I'd say, the easy win this year. Make sure your OFR does disclose your material business risks and that it isn't advertising. It gives a balanced view of your business, its prospects, and how it's going. Other areas of focus are not that different from previous years. We've got impairments and fair values is always in there, and non-IFRS financial information is in there too, as is provisions for onerous contracts, rehabilitation and the like. I think the more interesting way to talk about this is, so what have ASIC been doing for people? And you can look at this because it's all media releases, and this is why you want to avoid getting caught up in their financial reporting surveillance, because otherwise your company name ends up on lists like this and people like me start making fun of you. So first one they caught out was Southern Cross Media. Now, the non-IFRS profit measures. Now, Southern Cross Media, to be fair, aren't the absolute worst non-IFRS profit measure I've seen. That distinction goes to Crown Casinos, Crown Resorts, who managed to put out a report with a non-IFRS profit measure for profit before the effects of COVID. So this notional theoretical profit they would have made had COVID not occurred. That was, I mean, at that point you were basically just writing fiction, and that's a fictional theoretical number. So ASIC made them not do that and re-release it. Southern Cross weren't quite as bad as that, but look, I've heard of EBITDA before, but they made up a new metric, EBITDIFE. So EBITDA, but they also added back impairments and fair value movements. And the problem was, if you want to do that and put that in your director's report, knock yourself out, you're allowed to do that. But on your income statement and your financial statements, you need to have only IFRS compliant measures. And that's what they had to do, and ASIC made them reissue their income statements. IDP is a bit of a niche one to do with Indian GST, but Emico is an interesting one. In that they had a specific trade receivable, and I think the debtor hadn't actually paid them for something like 9 months, but they hadn't recognised any expected credit loss provision or any bad debt. So ASIC understandably queried this because they had a specific debtor that had made no payments for, I think it was something like 9 to 12 months. And once ASIC queried this, they ended up increasing their bad debt provision from 200,000 to 25.6 million, which I would suggest sounds like quite a material increase in the provision. So obviously embarrassing for them. N1 Holdings, what they were doing was they made loans, but they were recognizing loan arrangement fees up front as revenue, rather than doing what they should have done, and incorporating it into the effective interest calculation. So a reminder for both lenders and borrowers, you recognize interest based on the effective interest rate, and that incorporates the effect of any administration fees, arrangement fees, facility fees, or similar fees. You don't just recognize them as income or as an expense, have to be incorporated into the interest calculation. AdSlot is what I call the don't be lazy, the don't be lazy media release, because what they did was they identified indicators of impairment. So they did an impairment test, but the way they did their supposed impairment test was they just took their market capitalization at 30th of June and wrote their assets down to that amount. Now you can't do that. You can't do that. Market cap includes all sorts of sort of ephemeral or ethereal things that aren't included in an actual fair value calculation. So ASIC made them stop doing that, and they ended up writing off 5.2 million of goodwill. So yeah, a reminder that you can't use market cap as a proxy for your fair value. But what you can say is that where you have market capitalization that's significantly below the carrying value of your assets, so it's significantly below, especially if it's for a prolonged period, then you certainly have an indicator of impairment, and you must do an impairment test. And that was the issue Tasman Resources had. Okay, quick note for anyone in the not-for-profit sector, just to say there is a new framework coming. It's still in discussion paper stage, so I'm not going to go through it in detail. Just say the interesting thing is in the for-profit sector, we've got tier 1 for IFRS, tier 2 specified disclosures, they'll be the same, but there will also be a tier 3 that will be further simplifications, including to recognition and measurement. So I'm not going to go through the details because it's still in the discussion paper stage at the moment, but watch this space. If you come back next year, I'll probably have more to say. And there'll be a framework where all not-for-profits report will be reporting on the general purpose financial statements, including tier 3, wherever that ends up. Note for anyone in aged care, if you have bed licenses, federal government is discontinuing those from 1st of July 2024, so you need to be writing them off, or at the very least, amortizing them so that they amortize down to 0 by 1st of July 2024. Okay, let's talk about greenwashing. So this is a new term that's recently made it into the dictionary, and it's basically about saying all sorts of grand things about how environmentally conscious, socially responsible, climate friendly your company is, but there's no substance to it. It's just advertising or marketing. So ASIC has been focusing on that, and they've been looking in particular at investments, prospectuses, statements in annual reports and the like that could be perceived as greenwashing. At the same time, the ACCC has been looking at greenwashing in actual advertising of products. So it's a focus of several regulators at the moment. And here's a few examples of where ASIC have taken regulatory activity. Now, the infringement notices are fairly puny in this instance, but the cost isn't the infringement notice, it's all the legal fees of dealing with it. Then you've got to write to all your customers, then you've got to update your systems and processes. So I wouldn't look at those and think that this is a trivial issue. And the issue is a number of entities got caught saying they promoted ethical or environmentally friendly investments, but there was no basis for it. Probably the one I'd highlight in particular is diverse trustees, because this is an example of sort of language to maybe avoid in directors' reports. Things about how you don't invest in polluting or carbon-intensive activities, or in activities that cause environmental or harm or have poor corporate governance. The issue Diversa had was that they had no parameters to define what that meant. So how much carbon did an activity have to produce before they said it was carbon intensive? They didn't define any of this. So kind of, that's some nice words they've written there, but they weren't actually really doing anything in substance. And that's what ASIC are trying to crack down on. That probably leads well into my wider discussion around ESG, because this is going to be a big focus of financial reporting and reporting generally over the next few years. In terms of in 10, certainly, and probably in 5 years' time, when you read an annual report, I think there's actually going to be 3 reports there. There's going to be the director's reports that we have now. There'll be the financial statements, which are audited, as we have now. There'll also be a sustainability report, and the sustainability report will have a sustainability assurance opinion over it. I think that's where we're heading. So relatively early days yet, but there is now an International Sustainability Standards Board, and they have started to issue draft standards. They've issued 2, IFRS S1 and IFRS S2, on general requirements for sustainability reports and also on climate-related disclosures. And the key thing, I think, is actually the thing at the bottom of the slide. There's up to 7 more of these to come over the next couple of years. So they're still in the discussion phase. So I'm not going to go too much into detail in this presentation. I'm just going to say, if you want to know more, do go and have a read of our website there, because you'll see we've got our Sustainability Matters series, and we talk about greenwashing. And we also talk about what are IFRS S1 and IFRS S2, what do they mean for you, and therefore what disclosures will you potentially have to consider in the future. Okay, so that's everything I had to cover today. Thank you, everyone. I hope you've found it useful. If there are any questions, do send them through the Q&A. I don't have any open questions at the moment, but I'll hang around for a minute or two. Otherwise, thank you very much. I hope you've enjoyed the session. We will be circulating the slides. We will also be putting a recording of this up on YouTube at some point. So if you have other team members that you think may benefit, they're very welcome to come and watch our video. If you have any questions and don't want to put them in the chat now, do feel free to get in touch with me. My email is ralph.martin@rsm.com.au, and we'll also put that in when we circulate the slides. But otherwise, thank you very much, everyone. Hope you've enjoyed it, and see you again next year for some more financial reporting updates.